On balance, I think the risks are certainly skewed in that direction. So yes, I do think they'll get worse from here. If you look at emerging market shares in local currency terms, they've fallen about 15, maybe 16%, moves around a little bit, but that's nothing compared to the fall that they had through 2015-16 when they came down 27%. And in crises in the past, if you go back to 97, 98, they'd fallen something like 40%. So the falls we've seen so far have been quite significant, and they do owe a lot to contagion, but they could get a lot worse before they get better. And the reason I think they could still get worse here is that the Fed is still raising interest rates. That's putting upwards pressure on the value of the US dollar, which makes life tougher for emerging countries. We've got the trade war threat, which would certainly weigh on the emerging world, and uncertainty about how much China is going to slow down. So all of those things are negatives for the emerging world. You've got a 5-year view, yeah, sure. Buy emerging market shares here, you'll do pretty well because the PEs are quite low. But if you're worried about the next 6 months, then I think it's too early.
And Shane, many have pointed to the midterm elections as a big risk factor that investors want to clear. From your point of view, is the right strategy to kind of hold steady and wait out that event, or are you already reducing risk, would you recommend?
We have reduced risk quite substantially. We have minimal exposure to the emerging world. It's a difficult one because we already have seen these sharp falls. So to sell further from here, you know, you may get it right or you may not. On balance, I'd probably still take a little bit of risk off the table if you haven't already. And I do agree that there are a few events coming up which could further weigh on the emerging world. You've got the trade announcement from the US on the extra 200. You've obviously got all the issues around Donald Trump, but you've got ongoing tightening from the Fed, probably the next one later this month. Looks like they'll do another one in December and probably in March next year. And then, of course, you've got the midterm elections, which are another event which could add to uncertainty and weigh on emerging markets as well. So, yeah, on balance, I'd probably, if you haven't taken off, I'd still take a little bit off, unless you can sort of take a longer-term view in your investments.
Shane, I want to ask you about Turkey specifically. I'll be in Istanbul tomorrow for that potential rate decision. And the question, of course, going forward is going to be, you know, how much independence does this central bank have? How worried should we be? What's your take?
We should be worried about those things, and the uncertainty on that front has been a contributor to the current crisis. You know, global investors don't like it when governments intervene, talk about new ways of doing monetary policy. All that stuff has been seen in the past, and it usually ends up badly. And Venezuela is an extreme example of that. So yes, I think it should be a case of hands off the Turkish central bank. They should be allowed to do what well-trained economists would tell them to do, and that in this environment is to raise interest rates to the point that it supports the currency. Then, of course, there will be a chance to cut them after that. But I think at this point in time, the critical thing is to stabilise things. Having government intervention in the central bank is not the way to go. That just adds to the instability and uncertainty.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.